Welcome to the Critical Minerals Roundtable Fall 2025 edition, and what a year it is. 4 years we've been running these things, and what a timely update indeed. Scott, lots been happening. We've been positioned for this, but damn, that rocket just flew. Who would have thought a trade war? Trade war set this whole thing up. But you know, when you look for value, and particularly in commodities that are going to power the future, you'll take it. Scott, let's give them a little bit of an overview.
Yeah, so it looks like critical minerals are top of mind for all investors, and so this is a very timely update. We've put together a diversified and pretty unique group of management teams across the critical minerals sector. I'm going to give you a little overview of who you're going to hear from. So first, you're going to hear from Terry Lynch, CEO of Polymetallics. Polymetallics advancing one of potentially the largest polymetallic discoveries in decades. Next is Corey Diaz, CEO of Anfield Energy. Anfield is imminently restarting one of only 3 permitted and constructed uranium mills in America. Next is Mark Bishop LaFleche. He's CEO of Ecora Resources. Ecora owns a diversified critical minerals royalty basket that's in high demand right now with everything going on. And next is Rob Weir. He's VP of Corp Dev for Lithium Royalty Corp. Lithium Royalty owns a diversified basket of low-cost lithium royalties with significant growth potential. And finally, you're going to hear from Christian Easterday on the copper front. He's CEO of Hot Chili. Hot Chili is advancing one of the largest copper projects in the world, not already owned by a major miner. So a good lineup to get a lay of the land, what's happened, what's going on right now, and what does the future hold for critical minerals.
Great group of subject matter experts. And just to preface, the way we look at critical minerals and the technology landscape as a whole is we look at through a lens of disruption at a reasonable price. And so for us, the way we think about critical minerals, we do believe the commodities that we do focus on are the ones that that have value in the market today. Now, the way the roundtable is structured, 3 key components. The first is around supply and demand, clearly important. Second component is around funding. Can't get this, if you can't fund it, you can't get it out of the ground. And the last component is each of the companies talk about their own unique projects and overviews and upcoming catalysts. Guys, enjoy the conference. Thank you.
Yeah, so I mean, it's interesting. I've met a number of leading political figures and defense contractors and defense industry people in the United States, and they're finally waking up to the enormous head start that China has with the Belts and Roads Initiative, where they've tied up a lot of the really interesting deposits. And more importantly, they thought through the concept of actually not just finding ore, but actually producing metal, so that metal could come into something else. It could become, a battery part. It could become, an alloy of some sort. So they got into the expensive and somewhat environmentally challenging field of processing. And now China, like for much of the the critical minerals, they control the processing, and that's what's really that's what the juggler they've got us by. So, but I think America's woken up, and when America wakes up, they move in a big way. So our sense of it is that the giants awoken up now, and they're they're obviously lighting up the defense initiatives and the DOE to make investments in companies and do contracts and stuff like that. So there's a corresponding response now by the Americans, recognizing that they need to protect their economy, which is potentially going to be levered by lack of critical minerals if they don't get in there get control. So as a result, they're now I think very motivated to get in control and make sure that their strategic initiatives, particularly in the defense sector, are protected in respect to supply lines for critical minerals.
I think it's both. I think you can't separate the two. I think higher prices provide an incentive for assets to be advanced, but I think governments also have to play a role from a regulatory perspective to provide either better guidelines or more streamlined guidelines in order to advance assets. But I also think the government can play a role, much like in the U.S., on the funding side, because some of these projects, require significant funding. You talk about NextGen, there's probably a multi-billion-dollar build out. And if you can get support from government, especially if the resulting, material or energy is going to be used within, the province or shipped elsewhere, I think the government could be certainly incentivized to be, a partner in some of these projects. So I think that, it's a combination of higher pricing, kind of regulatory relief, and also funding. Those are the three things that need to be in sync in order to advance assets like NextGen.
Yeah, but first and foremost, copper. I think the fundamental outlook for copper is very, very strong, and I'm not alone in that. And it's no surprise that Ecora has deliberately targeted copper as our core exposure. Equally, the demand growth outlook for uranium appears very, very strong. And that's an interesting part of our portfolio that at times is overlooked in the context of the wider picture, which is really base metals driven. But there is very strong uranium exposure and growth in the future. And third, in terms of entry points today, for investors looking at Ecora, commodities like nickel are absolutely out of fashion. The Ecora portfolio today offers some of the two of the three arguably most advanced projects in the West. That's Piaui's the Piauí project on Brazilian nickel, and also West Musgrave, which is a copper nickel project in Australia. And two of those projects are materially permitted. They're at the front of the development curve. And so from an investor perspective, I think in our portfolio, there's a lot of torque to an entry point in that commodity at this point in the cycle.
Exactly. And at the moment, look, those traditional areas of copper demand, they're large. They don't need a lot of push to suddenly be requiring another 1 million tonnes per annum of copper metal into the market, which is just not possible. We have a huge amount of lethargy or inelasticity in the market with future demand. For Hot Chili to be holding one of few projects with production capacity of around 100,000 tonnes per annum, when there's only 4 or 5 independent projects like that in the world, there's a real, a lot of pressure on the existing major miners of the world to unlock new supply out of their portfolio, and we're really not seeing that. So at the moment, there's a lot of M&A going on. There's a lot of musical chairs on existing production. The first announcement of a mega merger with Anglo and Teck, but that's about the existing supply book. But now we're starting to see an overlap of where these companies are starting to position for new supply outside of the existing supply book.
Yeah, I love that question. It's without a doubt battery storage and then long haul trucking. China sold more electric long haul trucks in the first half of this year than they did over the entirety of 2024. So it's just something that people don't talk about right now. And you tell me how fast battery storage is growing. China just came out with 180 gigawatt forecast or goal for 2027. And China tends to overshoot those goalposts that they put out into the market. If they hit it, it would be 1 million tons on an LCE basis, which is the entire marketplace in 2024. So it's definitely battery storage and electric long haul trucking.
Well, I'm going to go off script here because I think there's a few. So I think I think that copper historically has tended to the long-term prices have tended to underestimate the true incentive price required to bring assets online. And you can see that if you look at the copper price long-term today on research analyst consensus forecasts, it's around $4.30 to $4.40 per pound. 5 years ago, it was around $3 per pound. And that's a big gap to move in only half a decade. I think cobalt as well. I think the demand growth side has been really overshadowed by supply additions. And in the medium to longer term, should those demand growth, that pace of demand growth continue, it'll far surpass what we've seen as a very chunky addition last year, primarily from one company and 2 operations that are quite connected. And then next is uranium. I think uranium is a commodity that is politically very charged. It's a type of commodity, like many of the critical minerals, but in particular uranium, where governments are reluctant to have supply chains that could potentially be impacted by other foreign actors or foreign states. And I think you see that today in the announcement of the U.S. government potentially looking to stockpile uranium sources to further insulate its supply. In that context, actually, Ecora has true world-class uranium portfolio with exposures at Cigar Lake, as well as NextGen's Patterson Corridor East development project, or Discovery in the Athabasca Basin, where to date, anyways, that exploration program has been hard to describe as anything other than geologically exceptional.
We've had a great rally in the commodities, and gold in particular, and silver. But it's early days, in my view, because all this is fundamentally a response to a massive money printing, right? So you've had fiat has been printed, beyond belief in all major, countries around the world, and so that has caused a lot of inflation. A lot of it has not yet come through, or they've changed the rules on inflation. They've just lied to us, basically. So we're, commodities, particularly finally, I think gold and silver, have broken into the clutches of the banks that had controlled them and manipulated, held them down for so long. And I think now they're broken free, and who knows how far they'll run. I mean, it's going to be a long way, is my guess. And of course, that ripples through the rest of the thing. And then you got the fiat pressure driving the precious metals commodities, and then you've got the electrification and urbanization, sort of major themes that are driving the critical minerals. So it's like, AI wasn't even a thing 6 years ago. Now it's taking 10% of the world's energy. Soon to be a lot more. Well, how do you distribute that energy? You got to have copper. You know what I mean? So you got to have nickel. You got to have these other base metals that act as conduits for distribution of the power. So you have this major almost once in a 1,000-year switch of energy sources, and it's like it's going to have a corresponding impact on the commodity prices, and that's all in the backdrop of the last 30 years where we've had almost minimal investment in mining, right? It's been the worst place to be, and the mining stocks have sucked. So you've got no or very small investment, relatively speaking, and now you got this realization that we need a lot more of this stuff. Well, of course, the commodity prices have got to respond. There's no other place for it to go.
Yeah, look, it is something that people in the copper sector are very used to tracking. It's one of the key things where most of the analysts assume a disruption to supply annually and make those forecasts. I think what's been really interesting is, just given the tightness of the market, of the concentrate market, and the upward pressure that's being exerted on supply because of lack of new supply, that any disruptions to a very concentrated metal market in copper, that they're really amplified. So when you start seeing major disruptions to projects such as Panama Cobre a couple of years ago being shut down, projects in Peru that are getting affected by a lot of community and social issues, and now a really tragic incident occurring in Grasberg with a mud rush into one of their main block caves. These things, when they knock out 1-2% of supply, what you're actually doing is making it very difficult for the physical market to get its hands on concentrates for the refineries. So this really puts further pressure underneath the copper price. We're pushing towards near record highs again, sitting at around $4.80 a pound. So a 20 cent per pound upward reaction by the market. Look, that was joined by news a couple of days prior with issues on production expectations from Constancia and Peru. So whenever we see these large projects that are putting out decent supply chunks into the industry being affected, there is a really pronounced impact on the price of copper. And we're starting to really be focused on that in the industry, because it is only taking small supply disruptions to have pronounced impact on copper price. No, look, I think where the world's gaze is on new demand areas, we're starting to really see that bedded down. AI will take its own journey. I think just like electric vehicles, AI, at the beginning, a lot of market analysts are very exuberant about the demand. The reality is the uptake and the impact of that demand as it flows in, and actually replaces some of the more traditional demand areas or segments of the market. These things generally take, anywhere up to 4 to 5 years to find out where that actual uptake will be. So the uptake models are important. With electric vehicles, they were. With AI, they're going to be. Really, these new technologies areas, these electrification areas, where we're seeing growing demand, are going to be, a big chunk of the future demographic of copper demand in the world. So the more traditional areas associated with construction, with electrical goods, these areas are certainly something not to take your eye off of. It's like that demand does not disappear. So very important to watch new construction starts in China, and also really importantly, what's going on in the US. It is only 10% of demand, but you shift demand by 10 or 20% in the US, an extra 1 or 2% of demand coming out of traditional areas of demand in the US market is also going to have quite a significant impact on prices.
Funnily enough, I mean, personally, we actually have a private oil and gas company. That's how we funded a lot of the stuff we've done. Thank God. But so I'm a believer in oil and gas. Do I think it's going to increase in value as rapidly as copper? No. I don't think it's ever going to go away. And I think there's an oil price that's probably going to rise modestly here in the short term. Copper, I expect to actually have a much more rapid increase. So I would invest more in copper today, and obviously we've got more of our portfolio in copper investments than oil. So we're writing our own checks in that respect. But I believe both will be positive. But I just think copper, just simply the supply demand constraints in copper are much different. It takes a lot longer to bring copper mine onto production than it does in oil well. So you can be much more responsive in oil than you can in copper. And usually I think what people forget, and what's probably still acting as sort of a depressant on the copper price, is this Dr. Economy legend, which has always been copper is Dr. Economy. If the economy is going to be depressed, copper is going to be depressed, and that has been right, of course, for many years. But this time around, it's going to be different because AI is just a completely category changer, and copper is going to power through any sort of depression, any recession, because we were getting 15% pullbacks in copper. You're getting just drop 3 or 4 or 5%, and that would totally damage the market price wise. But that's not going to happen now, because the AI demands are going to be outshooting everything, and it's going to drive up even in a down economy. Copper demand is going to go up. So, and of course, we're seeing supply constraints all the time. And it's like aging infrastructure. We saw Grasberg with that horrible incident. God bless those poor people. And we're seeing, who knows how long that'll take to get back to full speed. But the news we're getting from the copper world on the supply side is generally bad. It's not like, hey, we got a brand new mine coming in production and we're hitting it. Even the good ones, like Ivanhoe with the Kakula, ran into some issue that sort of slowed them down a bit, and that was a new one. So it's just much harder to bring these things online. So it's not as reactive to supply as oil, and as a result, I think copper is just going to be much more flexion to the upside, because that's likely what's going to be the squeeze on the supply demand curve.
Nothing's changed. More, if anything, it's become more focused. I think when the government had an idea of energy security and security of supply and nuclear energy, I think it was just learning kind of what are the requirements, in order to meet, that expected demand, kind of increasing, nuclear energy by 4 times in the next, 20 to 30 years. So getting a bit more granular. So I've seen the government's become a bit more granular as to understanding what are the things that are required in order to build out this entire value chain, from mining to conversion to enrichment to fabrication and ultimately building reactors. So the government's become a lot kind of, sharpened its pencil, I guess you'd say, understanding that each of these parts is unique and requires, kind of unique solutions for each section. So we've been encouraged by the fact that there have been kind of, outreach from the government to discuss, specific items related to mining and milling, for example. And we know that having conversations with other parties in the value chain, that the government's doing the same for each of those sections to understand exactly what's required, whether it's funding, regulatory relief, or something else. Well, yeah, I think you hit the nail on the head in terms of the low volume, right? So there are very few pounds that are being produced in the U.S., and those are likely being absorbed in the U.S. market. They're not necessarily going to utilities directly. I think some of those pounds are ending up in places like SPUT or other, other parties that are third parties that don't actually require the pounds. I think the utilities are certainly there and maybe buying from traders or other parties in the marketplace. But right now, in terms of direct pounds being acquired by utilities, I think that volume is pretty low, especially from North American producers. That'll change, obviously, as the spigot gets turned off from Eastern Europe and Asia. Those pounds that we used to come to North America are now going to China. So there are fewer pounds coming from overseas. So it's likely the utilities will have to start ramping up domestic consumption in the near term. But obviously they need the volumes there in order to be able to purchase. I think it is in the near term. It's probably not ideal because there'll need to be a ramp up in terms of production in order to replace the pounds that would be coming through Russia or any Russia controlled states like Kazakhstan. Things like enrichment are still dominated by Russia. So until you have the ramp up of that infrastructure in North America, it's going to be a challenge to kind of wean off of Russian or Russian related supply.
Yeah, so I think right now, if you've got a good project, you're able to get funded. So that's good. Unfortunately, not much of it's coming from Canada. Historically as it used to. So and like in our last round, where we raised 50 million, we raised half in Australia, or 25% in Europe, 25% in the US. Only the Robert Friedland and Robert McEwen, who are obviously Canadians, and wrote checks, individually. So unfortunately, the Canadian funds were, either like 1832 is in and is a great investor, but they just maxed out. I mean, the companies just don't have the capital that they used to have. So that's a challenge, I think. But now that the commodity cycle has turned, you're getting more retail interest in and you can get these deals funded, and you're starting to see more generalist funds come. We did a non-deal roadshow in New York 5 weeks ago. Saw 10 generalist funds. I was like literally the first mining guy that many of them had seen in several years, and they got 10 orders. Now we told them we weren't going to do a financing, so we said it doesn't matter, you got orders, it's not going to be filled here, get in the market. So so it was like that, but it's good to see them out. And so I think that and I was just out. I was in California this week, and I did 7 cities or 7 cities, I guess, basically in about 4 days, and had lunch and dinner meetings with ultra high net worth family offices and this sorts of things, and maybe met 150 people. And I would say that there is a lot of interest. These are generally tech investors. But now they're looking at investing in commodities because they're realizing, hey, I've got to start to diversify and take some of the toppy money off and get into this other cycle. So I sense, it's still not euphoria there. There's still a lot of good companies out there that are still struggling. I see still see a lot of like junior goals that have decent resources but still haven't really gotten their fire underneath them yet that you would expect that when gold is this high. But so that funding hasn't come into the funds yet. They don't have a pressure to put the money out. So I'd expect like we're going to be listing on New York, and the stat we found out was that New York used to be 10% mining back in the day. Today it's less than 1%, and almost half of that would be ETF stuff. So really, if it goes up by 2 or 3%, it's going to quadruple the amount of money that's coming in. So that's going to come, and it might be several times that. The taxi doesn't even know how to spell gold, yet let alone talk about investing in gold. So we're still in very early days. So. But you remember back in the housing thing, I remember being in Vegas for some conference or other, and I was with my partner, and this cabbie was telling us about the 3 houses he owns, and he's looking at buying another house, and I looking at my buddy, I'm saying, well, this housing market's just going to crash. You just know. I mean, it was like insane, and it was, but and it's like it's and then crypto sort of went through that phase. Nobody's talking, like in this room, I asked people, before I would start the show, I said, well, how many of you guys own gold? And like almost none of them, you know what I mean? So it's like so early. It's so early.
So Ecora operates in critical minerals basket. And arguably, I think that's a little bit different to how a precious metals royalty company may see the world. In the broader critical minerals sphere, I think what you see is generally choppy equity markets, and capital on equity capital may be available for some, but certainly not everyone. And you see fewer financial institutions participating in asset level debt funding and debt financing. And you combine that with, on the other hand, general confidence in the mining sector from mining sector execs to proceed with project development and capital projects more generally, as a result of expected demand growth trends and supply shortages in the future. So these conditions that we see in the critical mineral space have been quite attractive in terms of creating opportunities, largely because the royalty product is really well suited to act as an alternative to equity, given royalty financing is generally far more accretive than equity, and certainly much more flexible than debt. I think the other dimension we've seen in the funding environment for the critical minerals basket is an acceleration of Western governments seeking to develop secure supply chains of critical minerals, in particular the United States government. There we've seen, number one, stockpiling. I just mentioned earlier uranium, but there's also an ongoing tender for cobalt, up to $500 million. And the recent MP Materials deal, stockpiling of rare earths and a 10-year offtake. But you also see public-private partnerships of increasing frequency and deal value and quantum. In that sense, Ecora actually is already well exposed to the U.S. government's efforts to build resilient supply chains via 2 of its projects. For example, the Rainbow Rare Earths Palabora project has indirectly the U.S. government via TechMet as one of its top shareholders, and also Brazilian nickel in Australia, the Piauí project, where you have DFC involvement again via TechMet. So I think the Ecora portfolio, as I mentioned, is well positioned to benefit from the broader capital market conditions, but also geopolitical trends that we've seen really accelerate this year in 2025.
Well, I'd hope we're at or near the bottom. It's been 31 months of pretty much constant pressure. But again, we guide ourselves to using the long-term consensus price. So, I think the way we structure these agreements are pretty standard. There's the same protections no matter what part of the cycle we're in terms of security guarantees, our rights, it's registered on title, it runs with the land. So we've been very conservative in our commodity price assumptions, and the way we structure these agreements doesn't change. We have an in-house counsel who spearheads that for us. So those are all pretty rigorous.
Yeah, Scott, that's actually a really interesting question. And when you think about a royalty investment, effectively what you have is one underlying agreement that could potentially run 3, 4, 5 decades plus. So we approach these documents very, very, very carefully. And actually, we follow generally the same royalty structure template for all royalties we create. But in part, we might not have as much insight into the question as to what a bull market or bear market contract looks like, simply because we deliberately try to avoid pricing royalties at times of bull markets. In other words, what we're looking for is entry points into commodities that, through commodity price cycles, offer price upside. If you're pricing a royalty at the very top of the cycle, actually you probably face more downside than upside in that circumstance. Or we look to do the opposite. We look to be patient. And we look for assets that have these very long lives, such that over multiple decades, what you can benefit from is that price appreciation, also simply on nominal terms, in addition to running multiple price cycles. So maybe not the full answer, and maybe not that helpful to you in terms of what question you asked, but I think that's been our experience at Ecora.
Look, Scott, it's we've been talking for a few years on just the market dynamics and where the interest is in copper. I think even 4 or 5 months ago, you and I were talking about the disconnect in the equity market versus the asset market for copper projects, advanced development projects. We've started to see that in transactions at many multiples to market caps, New World Resources, Xanadu, Rex Minerals before that, Matt Copper transaction with Harmony. So we're also starting to see a lot of joint venture partnership arrangements, Sumitomo with Rio Tinto and Winu, and the recent transaction with Mitsubishi Corp and Hudbay. These transactions are occurring at many multiples above implied valuations of those assets in the market. That has started to occur now, whereas 6 months we were talking about a dissociation between equity prices and asset valuations. Now we're starting to see that bridge gap and close. And so what we're actually seeing is the copper equities are starting to move. Certainly Hot Chili's price is moving, and a few of our peers are moving. So we're starting to see that interest trickle down from the producers into the developers and also approaching into some of the explorers. So it's great to see. It's actually only probably about 6 or 7 weeks old in the market. But this was something very similar that happened with gold about 6 months ago, where everybody was wondering why the gold equities weren't reflecting the current price of gold environment. And so that's what we're starting to see in copper now, and it's a very welcome sight. I think there's been a very long period of recognition that the copper space is probably going to be one of the leading spaces for investment in the mining sector. And now that we're starting to see, those first of the mega deals, several attempted mergers amongst the majors, now that's starting to move into the independent developers, both takeovers as well as partnership arrangements. I think that you see a huge amount of interest starting to come into the sector because the corporates are arriving. There's generally a sign of the early stages of a bull market. So not a lot of the things that are going on are things that you can put against your model of how a cycle works and not recognize that most of the things we're seeing are very much green shoot period of a bull run. And so that generally now starts to attract not just the specialists, starting with where your question was, but generalists. We're seeing that now stock. We're hearing that those generalists are also out buying basket approach on copper equities. And the good thing about copper equities, there's not many of us, surprisingly, particularly in the Australian market. A few more in the North American market, and I imagine that a lot of eyes will be on that space in the North American market because there's a little bit more choice. In the Australian market, there's very little choice for exposure from investors. On the independent side, we maybe have 2 or 3 notable producers that are exposed to production, and we probably have even fewer developers, quite a number of explorers. So it's certainly a space that's getting attention from generalists now.
Well, I'd say a personal bias I would have is that governments are pretty lousy investors, and they're far too involved in industrial policy, pretty much globally, certainly in North America, and Canada is no exception to that. So, look, I'd be naive to say that we're way behind the sticks in terms of China, because they've been such big sponsors of companies like Zijin and other global champions. And no doubt their support's been essential to their success. But I think, the government picking national projects of interest, like the 5 projects Canada put out, were already well down the path. So I think there are certain areas where they can bridge the gap, but I think them sitting policy and taking direct stakes is long-term going to be a mistake.
Well, I think for us, because we're now on NASDAQ, we've opened up a whole other swath of investors or prospective investors to the company. Whether those are investors that like to invest in U.S. assets like our assets, because we're all U.S. And then there are certainly generalists who are getting involved, especially because, this talk of AI and the potential partnership of nuclear energy and AI, that opens up a whole other, potential pool of investors who may have an interest on the energy side. So we're seeing a much wider pool of potential participants in the sector. Yes, I think so. As I mentioned before, the government's becoming a lot more granular to understand what is required of each piece of the value chain in order to, advance those assets. So I think, the government, getting more involved, understanding better each of these different sections and what's required, I think is, we've been seeing it, and we've been kind of, positively surprised and encouraged by the work being done by the government. So from our perspective, we're playing an educational role too. These are not just one-way conversations. We're letting the government know what we'd need in order to advance the assets and ultimately be a contributor to kind of the U.S. domestic supply chain.
Yeah, would I love to see a premium for Quebec and Ontario produce lithium, cesium, nickel? Absolutely. But I just look over our investing careers. Canadian oil and gas was the most ethically and responsibly produced barrels in the world, and they sell at a discount. So as much as it would benefit us, I think it's very unlikely, and low cost is going to win. We intentionally constructed our portfolio to be generally high grade, low cost assets in safe jurisdictions with low technical complexity. There's 2 exceptions to that because the operators are world class, and that's Zijin and Ganfeng in Argentina, and they're building 2 brine assets in Catamarca and Salta called Mariana and Tres Quebradas. I think their invested capital is close to $1.4 billion. Don't quote me on that number, but they've been pretty consistent about building out these projects during the downturn. So we generally say we're the ABCs of hard rock: Australia, Brazil, Canada. 2 exceptions are the 2 big brines in Argentina. Mariana was inaugurated February 12th, and Tres Quebradas is actually in production, 20,000 tons of lithium chloride. So those are multi-decade asset, and those are company building assets for us.
Well, we've got an amazing discovery at Nisk, which is near Nemaska, Quebec. If you were to choose a spot to have a discovery, it would be at Nemaska, Quebec. Honestly, it's off the road. It's in a province that has done a great job of working with the First Nations. So we've got a phenomenal relationship with the James Bay Cree. So that's a tick. Community interests are great. The other thing is the fiscal incentives in Quebec are the best in the world. You can get 2-for-1 exploration and 2-for-1 development. You can't get that anywhere else. So all those things are fantastic. And then the project itself was a simple nickel sulfide project that we were expanding. And then in looking for more nickel sulfide, we found this massive copper precious metals zone called the Lion Zone, and we crushed it. It's literally 45% copper, 55% precious metals, platinum, palladium, gold, silver. And, it's, I don't know, analysts are saying 8 to 13 million tons, 5 to 7% copper equivalent. And that was, almost 6 months ago, and we're growing. And we raised $50 million, and we've pretty much the top mining investors in the planet. Robert Friedland's written 2 checks. Rob McEwen's written 3 checks. Gina Reinhardt. I mean, we've got the who's who really in the zoo. So we've got a lot of people that know a lot about mining and are not looking for 10% gains. They're looking for 10 baggers and 100 baggers. So they're big investors. So we've got the capital. We're ramping this thing up. It is a orthomagmatic deposit, and they come around every 20 years. They're literally the best mines in the world that you can find, better than any gold mine, better than any diamond mine, better than any silver mine, any uranium mine. If you had your wish as a miner, you'd want to find a polymetallic, because that you're looking at $700,000-$800,000 rock. Wow, that's just crazy. So the top mines like this, Sakatti, that's the Anglo-American last discovery of this sort in Finland. Previous to that was Voisey's Bay. Before that, Marinsky's Reef. And then your Norilsk is the mother of them all. So the biggest and the only $1 trillion mine metal in the ground project out there. So we found one of these 20. We're the 21st. We think it's going to be big. We quadrupled our land package this summer. That was our biggest moves. And we're coming out all guns a-blazing this fall. So it's a great time to be looking at power metallic. The historical context is that the previous 20 have all become mines that produce at least 1 million tons of contained metal. Some have been more than 10 million tons. Okay, so those are major or super major. And again, the thing that really stands out from these is the in situ value of the rock. So you're getting rock that's coming out of the earth at $500 a ton, $1,000 a ton, depending on these things, and your processing cost is maybe 10% of that, $50 to $70 or something like that. So enormous leverage, right? And so that's what makes it such an attractive thing to find. And and the fact that they're so scalable, that they grow so big, you're going to have a 20-year mine life and over a big mine. So these are major makers, not just company makers. So that's what makes it so exciting. Basically, resource deals ultimately ride on resource value in the ground. So there's 2 ways that can grow, right? By the drill bit, so you find more resources, show more tonnage, show increased grade or whatever. So you increase the value, in situ value in the ground. That's number one. Second is the commodity price expansion. So it was, funnily enough, since we did that financing at basically our investors paid $1.45 because of the Quebec way we can work with the tax credits and flow throughs. We actually as a company received $2.50, so that was great. But right now, stock's around $1.50 or $1.52 or something like that. So you're just a little over issue price. Yet in that 6-month period of time when we got that cash and we're putting it to work, now we're getting our results out. The copper's risen by almost 8%, I think, and the precious metals by 50%. So the value in the ground, without us doing anything else, has just gone up a whack. The stock has not responded. With the reason why we raised the $50 million is I think people thought, and I believe it's valid, that we were trading at 20 to 30 cents on the dollar of what we'd already found, and we're going to find a boatload more. So what's going to drive things is basically assay results. Okay, we're moving to New York. We'll be listed in New York end of October, early November, we believe. So that's going to move to a much better capital market where I think liquidity will be improved. And then we'll have the full MET study out probably early January, maybe this year, but most likely early Jan. So all this stuff is exciting. So, I mean, this is stuff that moves, and I don't know when this thing is going to meme it out and break through, but it's definitely on the horizon in my view. But I'm long and therefore recommend. So.
Ecora is a London TSX and also trades on the OTCQX. We're a critical minerals focused royalty company. We're a business with a history in metallurgical coal, so steel making coal. And for the past decade, we've been redeploying in large part the cash flows from that met coal royalty into critical minerals royalties. As we find ourselves today in 2025, it feels as though we're really at an inflection point where we're expecting to see substantial growth in our critical minerals revenue and really demonstrate the free cash flow generation potential that exists within our critical minerals royalty asset base. And at the same time, see a runoff of the met coal royalty. So in that sense, it's a business that met coal is certainly out of fashion, but critical minerals and the growth we offer, we think, is very interesting to many folks who like the idea of having exposure to critical minerals, but via the relatively lower volatility and lower risk framework of the royalty company. Yeah, well, as I mentioned just now, we're really at this inflection point, it feels like, in particular the next 6 to 12 months and beyond, of course, but there's a lot to happen in the next 6 to 12 months. I think the first, just further demonstrating the cash generational potential that exists from our producing our royalty portfolio. And you can see that in the first half of the year, where we saw an 81% increase in our base metals related royalty income versus the same period last year. And that volume growth is expected to continue into H2 and next year as well from base metals assets in our portfolio. I think the second key point is the de-risking of the next phase of growth from brownfield expansions that apply to assets already in production. And next year in 2026, Capstone Copper, for example, has indicated a target of releasing a feasibility study in relation to the phase 2 expansion at Mantos Blancos, which is quite meaningful for Ecora, given the asset this year guidance is around 56, the midpoint of guidance is around 54,000 tons of copper production. And phase 2 expansion could contemplate increasing production by 35,000 tons. And all this is off of largely existing and underutilized equipment. So the type of project that would attract very high return on invested capital that mining execs really seem to love. The third development in our portfolio in the next 6 to 12 months are major de-risking events that apply in relation to assets that are very far advanced in their development. So really up against the development curve in terms of being permitted, or in terms of being very close to a final investment decision to start construction. So to give you an example, one is Capstone Copper is targeting bringing in a minority partner to the Santo Domingo project, where we have a royalty. And on sort of long-term forecast prices today, over the first 6 to 7 years, that royalty is expected to generate $30 million a year, which is quite meaningful in terms of our future base metals-driven growth. Another example would be a definitive feasibility study at Rainbow Rare Earths Palabora project. And this project ranks among, if not the lowest capital and operating cost rare earth projects globally outside of China. And I think we've seen in the last 6 months the global implications of almost 90% of rare earth oxides being produced in China, whereas part of the sort of trade dispute, manufacturing lines almost grinded to a complete halt in the auto sector, certainly as a result of shortages of these rare earths. And that, interestingly, it's not EV necessarily manufacturing, although that's definitely a factor, but the supply chain impacts apply also just to regular, old-fashioned, if you will, gasoline-powered engines and cars, right? So then this is just one sector. So this project, anyways, is really well positioned to come into production very quickly relative to other producers. And this DFS is expected towards the end of this year, which is a key milestone towards bringing that project ultimately to funding, construction, and then first production. Another area of our portfolio is the closing of an $80 million Australian financing to restart cathode production at Cyprium's Nifty mine. That would be phase 1 of the second part, where phase 2 would contemplate restarting mining operations, which existed previously, and thus from a permitting perspective should be much more straightforward than a greenfield development. And that project, should the mine restart, is targeting life of mine production of copper on average of 35,000 tons of U contained in concentrate. So those are just a few of the many things we expect and catalysts that we expect in the next 6 to 12 months. But ultimately, I think that what they're all connected back to is, number one, just further demonstrating and providing more confidence on the really strong cash flow potential that exists in the royalty portfolio that we already have, that we've already acquired, that we've largely already paid for.
Sure. So I guess on the mine side, We're looking at the construction of Velvet Wood, commencing by the end of the year. So we've got, we've got the federal permit. We're just about to get our state permit. We're going to start, clearing some of the area around the mill. We're going to open up the portal, start dewatering the mine. We'll build a barium chloride facility in order to, run the water through it in order to clean it, and then start, building up and constructing the mine by the end of the year. So there are a number of things that are going to happen at that site. The aim is to have that open and ready for production in mid 2026. We're currently working on a drill program at JD7, so one of the West Slope mines. That's more for mine planning. And after we've completed the drilling and we've determined the results, we're going to put out a plan of operations, submit a plan of operations to the state and to the federal government in order to advance that asset. So once again, as a reminder, because we're expanding the throughput capacity at the mill from 750 tons per day to 1,000 tons per day, gives us a bit more flexibility in terms of adding more mines to the mix early on. We'd previously just talked about Slick Rock and Velvet Wood as the two assets that would go through initially, but we could certainly add another mine. So JD7 is one of those candidates for kind of additional feed early on into the mill. We're also working on a plan of operations for JD8, another West Slope mine, and then Slick Rock doing the same. A plan of operations we'll be submitting probably in the next 60 days to the state. So once again, advancing that to the next step so we can start, working on it, doing some construction at site. The idea is probably, one or two of those mines will be ready by the end of 2026 for production. And then rolling into the mill side, we're working on the radioactive materials license review and application. The review is going well. We have a third party helping the state to help accelerate that process. We expect to have the review completed by Q1 of next year. In the interim, we can start pulling out some of the items within the mill under our current license that we won't be using going forward. So there's some pieces in there which are old. They haven't been used, but they're old in terms of age. And some emissions, for example, emission standards have improved. For example, our gen sets, they're relatively new, but emission standards have moved on in the past 40 years. So unfortunately, we can't use them, so we have to replace them. So we'll replace the gen sets, we'll replace the electrical within the building, and we'll also pull out the leach tanks. So we're preparing for refurbishment once we've got the license, the updated license in hand. So we've got a few things on the go in terms of work at both the mill and the mines. Yeah, I guess from our perspective, we're going to be looking at probably equity be the first component, and that's because we've just moved on to the NASDAQ. We're drawing a significant amount of interest in the U.S. market, and certainly we'd like to get U.S. investors involved in the story who haven't been able to participate in the relative near term. So that would probably be the first step. But we're also at the same time, having discussions with the government. As I mentioned, the U.S. government is also keen to support the industry, whether it's through kind of a regulatory position or, potential funding. So we've had conversations with various departments about the potential of funding. So that's one avenue that we're also considering. But, finally, the debt opportunity, that's not non-governmental debt is also available. We've seen some of our peers raise significant money in the debt markets, convertible debenture market very recently. And so we know that's another avenue. We've had early stage discussions with providers of similar structures. So, as I said, we're open to all kind of avenues of funding. I think that, once again, the opportunity for us being on NASDAQ is to look at greater liquidity and also a larger pool of investors. So certainly we'd look to tap that market in the relative near term. But like everything else working in the background, the government debt component potential and the convertible debenture or some form of debt, project debt is also there and available to us. I think in the near term, when it comes to Velvet Wood, the larger funding is going to be tied to the mill as opposed to the mine. So, in the near term, any kind of equity investment is likely to cover any costs related to advancing the mines, with a plan to look at larger investment project financing, probably, into 2026, closer to receiving approval for the radioactive materials license upgrade. Well, there's money. It's it's interesting because there's certainly money within the government, and we've seen some companies get funded. But once again, even within departments, there are certain pools of money dedicated for, whether it's rural development or other things. So it's also a question of navigating the departments and understanding where the money is. I think one of the pluses of having Jeff Duncan on our board, he just recently joined. Jeff is a former congressman, was a congressman for about 14 years, and understands the appropriations process, understands, where monies are usually provided, how to access those funds. So he'll be able to help us navigate, various departments and understand where those pools of funds are that we could potentially, access. So it's complicated in many ways, but there certainly is money there. But sometimes you just need to have a champion in order to kind of help you access those funds.
Yeah, so we're a lithium royalty company. We're the only one in the world. I would have expected to have a little bit more competitive tension, but I think the pressure the lithium space has been under the last 30 months has kept people out, which is fine. We've got 35 royalties in total. We have 3 in production, 3 that are in the final stages of construction, and then a whole bunch of development assets that will bubble to the surface as we see this market come back to some sort of equilibrium. But as I said earlier, the focus was high-grade hard rock, safe jurisdictions, low technical complexity. So we take a lot of risk off the table by avoiding Chile, Mexico, Bolivia, places like that where investors would be concerned. Not to say we don't look in those areas, because there are some very good assets there. But I think once we've stacked more producing assets, we can maybe venture a little further afield and take on a bit more risk. But we're 35 in total. Hopefully by the end of 26, we'll have at least 6 producing royalties, which would be about 60% of our net asset value, which is a huge threshold to get to, because that's where the market starts to re-rate your business. Yeah, athletes like to talk about stacking days. We like to talk about stacking assets. We're at 3 in production. We're hopefully going to be 6 by the end of 26. So I think showing the market that consistency, because these are multi-decade assets for us. And the reality is, just on the 6 of the 35, as I said earlier, represents 60% of our NAV. Depending on, you can use goalposts of 750 and 1500, and those assets would generate 18 to 34 million a year of revenue. So I think once we get through that phase and we get a price back closer to 12 to 1500, then we can start going into things like Winsome and Adina that, on an undiscounted basis would pay us $300 million over a 17-year period. So they're doing everything they can, and they're staying afloat and being very intentional and patient with their decisions around Adina and buying the Renard mine related infrastructure. So it's stacking producing assets and showing all those characteristics that the market loves about royalty companies, with 85% EBITDA margins and that great consistency and predictability the model affords. Yeah, we're at the bottom of that price to NAV table. I think mostly a function of the price. We don't control the price, so we have to show the market that we can execute and that we've underwritten and we've partnered with good management teams that are able to navigate these headwinds and build these projects and be positioned for when the prices recover. So I think it's just showing that consistency and that those deliverables of getting these big assets. Tres Quebradas is 20% of our NAV. It is now in production. The market's kind of looked past that, but over a 4-6 quarter period, and they see the consistency of those revenues and the EBITDA that comes with it. I think that's what's ultimately going to get us to where we want to be.
We've had to be very, very careful in what the company says at this time. We've just completed a very successful rights issue, very well supported by our shareholders, particularly our major shareholders within the top 20 and top 40. So that's been a fantastic outcome. You mentioned that the price has been strengthening. It's almost defied gravity during a period where a rights issue was placed at a premium at the time. The stock was 58 cents when we announced the placement price at 60 cents for our shareholders. And that was very well taken up. The stock is trading near $1 at the moment over the last 5 or 6 weeks. So we're very, very happy to see that. But we're also very cognizant that that was from a very low point. And that disconnect in valuation was something we've been beating the drum about a lot at Hot Chili. So it's great to see that valuation gap closing. We believe that there is quite a long way to go before we start reaching asset valuations. So really the two key areas that the company has committed to out of use of funds on that $14 million placement to our shareholders was really primarily around us completing a very long investment in a strategic partnering process. The company is at that point, completed pre-feasibility on our large 116,000 tonne per annum copper equivalent production base over 20 years at Costa Fuego. A pre-feasibility completed and first numbers out on our Wasco water business. So it was the point where we could contemplate bringing in partners into both of those projects to assist in funding at a significant discount to implied dilution of issuing equity out of the market. So very much the placement that we've done to our shareholders was to give back further consolidation opportunity and exposure to our shareholders. That was really well taken up. So I'm very, very pleased. And that's provided us with working capital to kick off drilling at La Verde. So the La Verde discovery, which the company has not forgotten about. We've had a fantastic start to that discovery with the first 10,000 meters of drilling. And now we've got diamond drilling going on, and that will put the finishing touches on what will be a maiden resource in the new year for La Verde, but something that looks to be very, very material to our resource base. 1 billion tonnes on the coastline already. We see that growing and achieving tier 1 status out of the La Verde discovery. But most importantly, what we're very focused on is what that does to the economics of Costa Fuego. So we've talked about copper price. That's a big lever when 85% of your revenue is based around copper in your production mix. But mine life addition, front end, higher grade mine life addition, the ability to push out the time frame on any expansion capital in the project, that has a very, very material lever on our financial metrics, on our post-tax NPV towards 50% upwards lever on that by adding in another 5 years of higher grade front end open pit feed, and a very, very large lever on the internal rate of return. It's probably the finishing touch that we need to put on the project before fully moving into the definitive feasibility. So our pre-feasibility optimization phase is on. We're going after one of the big levers on value that we can demonstrate to the market. So that's going on in the background. But most of the executive and management group in Hot Chili are actually focused on a very detailed process with multiple parties looking at potential partners for our copper and our water assets, or both. And so that is progressing very well. We're hoping to conclude that process in the fourth quarter of this year and conclude that process very patiently, trying to find the right project partner for these projects at the right valuation, at the right structure. So it's something that we're very carefully doing, because we know what kind of dramatic re-rate that can provide for our shareholders. And we've seen that when you look at assets like Winu from Rio Tinto. They were able to bring in a 30% partner at Sumitomo, $400 million US for 30% of that project. That is a project that is about 3/4 of the size of Costa Fuego and orphaned in the desert 300 kilometers from coast with 90 meters of desert sand over the top. So when you look at the more recent transaction with Hudbay on a project that line by line, mine life to scale to NPV to IRR is almost a dead ringer for what Project Hot Chili has at a very similar level of advancement. They were able to bring in Mitsubishi Corp for a 30% partnership for $600 million US. So these are the type of value pointers that are going on in the market. I think there's a realization that Costa Fuego is one of very few large-scale advanced assets that now we're starting to see M&A around, both from partnership and takeover. So that is driving people's views on our valuation to many, many multiples as to where the stock is at the moment. So we're trying to very carefully navigate that, and we'll update the market on that key catalyst on partnering when we're ready.